Does the presidential campaign affect the economy and the stock market? Joining us for this week's Smith Business Close-Up is David Kass, a Tizer Teaching Fellow in Finance at the Robert H. Smith School of Business. David, thank you for being with us.
Well, thanks for having me.
So let's talk a little bit about the interaction between all of those things. First, the impact of the election on the economy and the markets. Does it go that way or the other way?
Well, I think it actually goes both ways. I think the economy could determine the outcome of the election, especially if the economy is very weak or declining. And the other side of the coin is whoever is elected would be setting policy going forward, and depending on the political party in the White House, that could go in a different direction than the one perhaps that was going in before. In terms of the economy, between now and the election, there are a couple of important reports coming out from the government, specifically the unemployment report. There'll be a report Friday before the election, November 2nd. Will the unemployment rate be going up or down? Certainly a rising or increasing unemployment rate will not be helpful to the incumbent, but a declining rate should be helpful. And also on October 26th will be the first advanced look at GDP, that is gross domestic product, for the third quarter. And in the second quarter, our economy was growing at only 1.5%. Is the economy slowing down? Is it speeding up? And I think this will be an important measure and perhaps determinant in the election.
What's the history of the relationship between presidential campaigns, presidential cycles, and the stock market?
Well, I have found that the economy actually is a greater determinant of the outcome, greater so than the stock market. And let me give an example. I looked back 80 years, going back to 1932, looking at incumbents seeking re-election, and there have been 11 incumbents seeking re-election, and on only 3 occasions has the incumbent failed to be re-elected. The first time was 1932, the Great Depression, Herbert Hoover losing to Franklin Delano Roosevelt. We had an unemployment rate of 25%, and a stock market also that declined by 89% between 1929 and 1932. The second time that an incumbent lost was 1980, Jimmy Carter losing to Ronald Reagan. And in 1980, we had a stagflation problem. We had interest rates that were high. Inflation, the CPI, was at 13%, and short-term Treasury bills were at 14%. So a very difficult economic time in that period. And then the third time that an incumbent has lost was in 1992, when the first President Bush lost to Bill Clinton, and then there was a recession. Now, what's interesting, in 1980 and 1992, the stock market had actually gone up that year. So the economy really dominated the impact of the stock market in those instances.
I understand you went to business school at Harvard with a gentleman named Mitt Romney. Tell me what you remember of that.
Well, we were classmates in the fall of 1973. It was a corporate finance class, and in my opinion, there were 100 students in that class. Mitt Romney, in my opinion, was the best and the brightest in the class. About half our grade was determined by discussion in the classroom based on a new case every day, and he did extremely well relative to the other students. So I was very impressed with him in that particular class.
So this endorsement sets you up to be the next Treasury Secretary, Ben Bernanke's replacement. What do you have in mind?
Well, I think it's getting a few steps ahead. No, I don't think anything like that will occur. I'm sure if Mitt Romney should be elected, I'm sure he has some excellent candidates in mind. I'm sure he'll do quite fine if that is the outcome.
Before we go, what is the history of how the market does related to the party of the president? In other words, under Democratic or Republican presidents, is there a difference in stock market performance?
Well, actually, again, it's an interesting question. I went back in detail to 1965, and I found even though the stock market on a compounded annual rate increased by 9.2% a year, including dividends, that's the S&P 500, the stock market actually did better under a Democratic administration. It went up a compounded rate maybe 10.5%, whereas under Republicans, it went up by a rate of 7.5% roughly. So the stock market does go up, whether it's a Republican or Democratic president on average, but actually under Democrats, the stock market has done better.
Interesting stuff. David Kass joining us from the Smith School of Business. Thank you very much.
Oh, thank you for having me.